Hey, what's going on, folks? This is Dimitri back again. In this video, we're going to discuss what the Federal Reserve just said about rate hikes and everything and all that. So, and yeah, it was really nice and easy, basically meeting there. The reason I wanted to discuss about it is because I wanted to share with my community, with you guys, and if you're new here, like and subscribe down below, because it helps me out a lot and I appreciate it very much. So because it is, yeah. So nonetheless, I wanted to bring you a bullet point and see, like, just nutshell what's going on in there and the relationship to the housing market, and specifically what I really took from it. Let's just get to the chase, man. So what really I got from Chairman Powell, so the Fed and all that, so for the community who doesn't know or doesn't really have, basically what's going on there. So Fed is a Federal Reserve, basically is, as far as I understand, is an agency that regulates the rates and all that. So meaning just basically sort of a central bank kind of thing going on. So they are basically setting up the tone for the economy to either expand, shrink a little bit and go all the way. So it's just like kind of premises, as my understanding there goes. But the nutshell, how it reflects on you, is that the way the policies that they implement is the way that you can feel it in your pocket, in the sense that your ability to spend money, your ability to buy stuff, things like that. Not directly, they're gonna come and tell you to do whatever, but indirectly, as their policies affect the businesses, and the businesses will be responding accordingly to sustain their situation, their ability to either grow or lower, and things like that. So yeah, well, Fed in this instance, and they've been doing those pretty much consistently, the meetings, about the rate hikes and things like that. Their focus is still on maximum, as I got my notes here, maximum employment and stable prices. So they are not going to implement more hikes as of today, and I guess in the very near future, because they apparently it's okay for now. However, there is a projection again, and I want to emphasize that's a projection, because it's not certain that they're going to do it or not. As they say, it's based on the information, based on the data, and based as they go forward, they're gonna do whatever needs to be done, basically, in that sense. So their basic idea is to keep employment and employment rate as it's supposed to, as they want it to be. That's their focus. They're gonna go there, and the stable prices. So that's their core idea that they wanted to sustain right now, as well as the goal is to get into inflation rate, as a 2%, right? As of I think today, I believe it's got raised a little bit. It was around, I think, 3%, I believe it. Not quite sure, not in front of my head, not in front of me right now, those rates, but that's the idea. So that's the goal, and they want to sustain whatever, employment again and prices. So that's being consistent, as like me going for just basic random prices. There are reason, definitely. It's not that they didn't, but for example, for the past couple of months, the, let's say, price for gas, which is like in my neighborhood, it's been about 339, something like that, as a maintain. It's like it was maintained there. So that's plus, right? So basically maintaining the rate that was their message, right? Again, so what they also emphasize is that more progress needed, right? So in the sense that they need more data that it's sustainable, they need more data that it's doable and things like that. And what else do I write down here? So we are fairly close. That's basically a quotation. That they fairly close where they want to go, but again, based on the data that they have, they will act accordingly. But so the projections again, and I kind of deviated from that, but the projections that he mentioned, Chairman Powell from Fed, he mentions in that his report that by the end of 2023, he says the rate they're probably gonna get to 5.6. That's their rate plus. So if you just basically just a guy from the street, or like me, basically not really related to that anyway, to their making decisions and things like that, but you're an investor or basically a consumer, right? You will have the base rate, and then the mortgage provider and loan providers, they will add their rate, like 2%, whatever. It depends on them, obviously, but it's like usually 1, 2, 3, whatever. So, and then they add that, and you get at the end of it, you get like, hey, your mortgage is going to be 6 or 7 or 8%. So that's basically it. They basically want to make money. Which is, yeah, but so the projection, obviously, as the base rate goes up, theirs goes up, and the price goes up. So, and I believe he mentioned in the end of 2023, which is today is September, so closer to December and all that. I don't remember quite from the top of my head right now what it is right now, but he mentioned 5.6. That's again projection again. There might be a hike. That's what he said. But again, it's a projection. So based on the data, that will be better acknowledged later down the line. So September, October. So I think we got like 2 or 3 more meetings for him to provide information. So don't quote me on that, but that's basically future will show. Yeah, end of 2024, next year. So we're still gonna breeze through that. It's again projection, again just mentioned. We're breezing through base rate 5%. That's what he mentioned, right? And it's really important. How? Because you are, as real estate investor professional, or real estate, or just in any type of shape or form, you're related to real estate, and this channel is this about. So like to subscribe again, shameless plug to support this channel. So, but yeah, if you're related to that, that's definitely going to be affected because of the financing and things like that. 2025, because I honestly thought myself, because a year ago when this whole thing started, like with the hike rates and everything, I was thinking we're gonna breeze through in the year, all that squared away, everything is fine, and then back in the business, kind of like that, back in buying properties and all that. However, that did not happen, and we kind of in the area. Well, definitely it was a chaos back at the beginning there, but right now it's kind of stabilizing, which is good. And it wasn't that quick of a I guess recovery, so to speak, so that I was kind of expecting, to be honest, selfishly. So, but nonetheless, 2024 again projection, again based on data, will be determined better, but as of he mentioned, it's going to be down to 5%, 5.1, I think, as far as I understood it correctly, and down and back in the future. So 2 years from today, I think it's like 2025, right? All the way through, or not all the way through, but at least to the end of it, they are kind of like shooting for 3%, meaning percentage goes down, and the interest rate goes down. Well, that's as far as I am interested in the real estate in real estate world. Definitely there are multiple and other areas that gonna definitely focus and maintain their or that influence their decision about the interest rates and everything. But as far as the I was listening to the questions from the press, they were telling me the mortgage or like the housing is not super important and for them, but like it's kind of there but not really. The main focus is the maximum employment that they want to think about and stable prices. So this is the tone that they set, this is the way that they wanted to go, and this is the basically the thing that they are shooting for. The aim is, again, so he was like really stressing on that. That's going to be 2% inflation rate. So meaning, like, as of right now, if you go and just type it in like, hey, what is the inflation rate today, you will definitely see that is like I think it's around 3%, something there. Yeah, as you go in and check this out, so you definitely will see what's going on there. And that rate they want to put into 2%. So, and just to get the basic understanding is that inflation rate obviously affecting the prices, and obviously they wanted to keep that stable. So after that, then there might be some movements towards, hey, you want to do better, or you want to change something and reduce the rate, which is highly anticipated from my side, to be honest with you, because it's really affecting the purchase power, because definitely affects the businesses to take more loans, in the sense because it's getting more expensive. So many professionals and the people who really in that area, they a lot of people select to wait and just breeze through that and accumulate cash, which is really appropriate and very good decision to do. So, but again, another gentleman said that I wanted to discuss, like I wanted to mention that, like, hey, if it makes sense to buy and that your market allows it and you are able to and good to, why not? Because at the end of the day, I wanted to bring that idea that you can definitely refinance, later down the line. Or if you don't refinance and then you guys basically 50-50 chance at this point. So you either refinance or you don't refinance, because if it's a 50-50 chance rate goes up. Well, as of right now, from my perspective, and as of kind of situation, you can do educated guess and everything like that, but at the end of the day, we don't know. It's a guess. It's even though it's an educated guess, but it still remains like 50-50 chance. Sort of like you got pretty much two decisions. You buy now and then you wait it, and then it's good. It's a risen rate. You good because you bought it in a lower rate, or you buy now again, and then rates goes down, and then so they're later down the line you can refinance again and get them, lock it in and call it a day. So either way, I believe there's a win. So, and if finances, I would say, I'm a proponent, if finances are allowing it, and if the numbers work, let's make it work, because not let's make it work. If it works, do it. If it doesn't, don't do it. That's simple as that. Yeah, and that's pretty much what I wanted to share with you guys. So this is a highlight. So rates are not hiking up as of today, and I think in the near future, but I think to consider, they still keeping focus on max employment and stable prices, meaning that as of today, and they want to keep as is. So, and the forecast is inflation rate going down to 2%. And lastly, I think there is three projections that I mentioned, that this year, next year, was still breezing through 5%, somewhere there. But again, and at the end of the 25, they wanted to hit 3%. So again, the last part that I just mentioned is a projection based on the data, for them. But again, that can change. So again, so yeah, that's pretty much me. So thank you guys for watching. I hope it helps you make better financial decisions in the future. And like I said, if the numbers work, definitely go for it. If it doesn't, it doesn't. So obviously. So for me, let's say like just in my case, it doesn't work at this moment, right at this right now, but it might work in the near future. So I'm actually analyzing things and see how it goes. So, but anyway, thank you guys for watching once again. Like or subscribe down below, and be treated out. See you guys next time. Bye bye.